Hello and welcome to the 5th Annual CSAF State of the Sector Call. My name is Brian Milder, and I'm the Director of the Council on Smallholder Agricultural Finance, or CSAF. I'll be moderating today's webinar, and I'm pleased to be joined by 3 guests who I'll introduce in a moment. First, a few logistical points. This webinar is being recorded and will be available for download next week at csaf.org. We've muted all lines except those of the presenters. To submit questions or comments, please use the chat box on the lower right of your screen. You may also email questions during or after the call to communications@csaf.org. Questions can be submitted at any time during the webinar, and we've set aside some time at the end for Q&A. So the purpose of this webinar is twofold. First, to share findings from the CSAF State of the Sector report that we released yesterday. The report includes data and insights from the 12 CSAF members on their collective lending to agricultural SMEs in Africa, Asia, and Latin America. The report is publicly available online at csaf.org. I would like to thank the Small Foundation for their funding of CSAF and this report, and also to thank our data partner, MIX, which has been collaborating with CSAF for the past few years to standardize and share our data publicly. The second objective of the webinar is to share an overview of SLE Africa, which is the new name for the blended finance initiative that CSAF began incubating about 18 months ago, and that is now an independent but affiliated initiative housed at the Global Development Incubator. In terms of the agenda, in a moment, Blaine Stevens, who's the Chief Operating Officer for MIX, will present the 2018 lending data and trends. Then we'll have commentary first from Michael Musau, who's Investment Manager for CSAF member Ultrafin, and then from Liz Mwange, who is Program Manager for SLE Africa. Both are based in Nairobi and will speak to their experience working across East Africa. We welcome your questions, either focused on CSAF lending globally or the SLE Africa initiative in East Africa. You can see on the agenda 2 hats for today's conversation. In addition to my role with CSAF, I'm also the CEO of SLE Africa, and I'll introduce the initiative and then invite Liz to share more details. Before going any further, I'd like to introduce CSAF for those of you who are new to this conversation. CSAF members listed on the bottom of the screen are first and foremost independent financial institutions making loans and in some cases also providing technical assistance to agricultural SMEs. They are peers and direct competitors with distinct corporate structures, lending strategies, and policies, and members come together as an alliance to share learning and promote industry standards and best practices for a thriving market serving the financing needs of small and medium-sized agricultural enterprises globally. CSAF undertakes technical work streams related to risk management, loan monitoring, environmental and social impact. And as an alliance, we're committed to sharing our learning publicly to contribute to the sector. The businesses that CSAF members finance range from farmer-owned cooperatives to private traders and food processors. These businesses typically share 2 things in common. First, they source from and create economic opportunities for smallholder farmers. And second, they typically struggle to access finance from commercial sources, such as local banks. We believe that a more competitive financial market serving a greater share of the demand for credit among agricultural SMEs and guided by responsible lending practices and impact standards will improve farmer livelihoods, create jobs, build resilience to climate change, strengthen food security and nutrition, and contribute to long-term economic development. And with that, I'm going to hand it over to Blaine to present the 2018 lending trends and to give you a glimpse into the new open data portal.
Thank you, Brian. And I think you can keep those slides up for just a moment, Brian. They just disappeared. But thank you very much for the opportunity to speak to the CSAF portfolio. For those of you who know MIX, you know that we believe in the power of information to support market development. This is something that we've been working on over the last 18 years, building out data tools and analytics from spaces and platforms like Mixed Market to the recent launch of the Inclusive FinTech 50, looking at early stage inclusive fintechs. And now, of course, with CSAF, partnering to bring better data insights to the agri-SME space. We think that these efforts are really timely and important. For those of you who've read the recent GIN Annual Impact Investor Survey, you know that food and agriculture represent an important share of impact investment across impact investing. And in fact, as Brian mentioned, since 2015, Mix has worked with CSAF to build out transparency and insight in this space and amongst their portfolios. Together, we've built out a core set of data standards shared across all CSAF members and that allow us, as a common language, to aggregate data across CSAF members to provide insights into sector trends and improve decision-making amongst those members. CSAF, as Brian mentioned, has made those insights available to the broader public as part of its State of the Sector report, including the one released yesterday and that they have for the last several years, allowing others to learn from their collective experience. And today and this year, CSAF is making a really important leap forward in bringing that data and experience we'll be looking at in just a few minutes, makes the richness of all of this collective experience available to the broader public to explore trends in financing agri-SMEs and producer organizations. So I'm really pleased to share some highlights from that portal. And again, in just a few minutes as I wrap this up, we'll be showing that to you live. So first, as you have on the screen here, I'd like to share a few headline numbers from 2018. CSAF members collectively dispersed just under $630 million in 2018, which is almost double the lending that they had just 5 years ago. That financing reached 711 businesses, including both farmer cooperatives and private enterprises across just over 60 countries and aggregating just over 2 million smallholder farmers, about 30% of whom are women. And those farmers affiliated with CSAF borrowers managed 3.3 hectares of land. Across sub-Saharan Africa, in fact, that figure is closer to 1 hectare. So we're really talking about smallholders here. So I'd love to spend a couple minutes to peel back some of those numbers and take a look at a few of the trends that we're seeing together. The 2018 data shows that CSAF member lending actually decreased by 12% and is now on par, as you can see in this graph, with 2015 levels. This is a reversal from average growth rates of 12% in 2015 and 16 and an average slower growth rate of 2% in 2017. The overall decline in disbursements that you see in aggregate is also observed across almost all regions. The one region that escaped this trend is South America, where disbursements actually increased by 6%. And that was actually making a recovery after several years of decline. The increases in disbursements from South America is largely due to a few commodities, Brazil nuts in Bolivia and cocoa beans in Peru. Overall, though, the majority of South American lending remained in coffee, 56%, and remained steady in volume from 2017 to 2018, following a long-term recovery in the wake of the coffee leaf rust outbreak in 2013-2014. The portfolio in sub-Saharan Africa, in orange on this graph, on the other hand, compared to South America, actually succumbed to that consolidation trend in 2018, as disbursements overall declined by about 6%, after 4 years of continual growth averaging 36%. So it's an important reversal. Even with this recent contraction, though, CSAF lending in Africa has grown tremendously in the last several years. 5 years ago, lending to Africa was just 1/4 of the combined lending to all of Latin America. It's now equivalent to 2/3 of that total volume. So it's been the fastest growing region within CSAF portfolio over the last several years. Then finally, in this regional view and disbursements to Central America also declined in 2018. 18%, following a small increase in 2017. Here we would call out a particular combination of both lower coffee prices and delayed purchase contracts, with particular effects Central America, since coffee is the predominant value chain that CSAF members' lending goes to in that region, as well as more cautious lending related to political risks in Nicaragua and instability in Honduras. So how does this overall portfolio consolidation play out across the value chains financed by CSAF? As you can see here, we're looking at the major value chains that 10 value chains that are financed by CSAF. In fact, more than half of the top 10 value chains financed by CSAF experienced a decline in disbursements in 2018. Coffee, in orange on this graph, remains the most financed value chain for CSAF members at 45%. But this is a decrease by 10% in disbursements compared to 3% in clients over the prior year. This decline largely comes from a drop in big loans to CSAF clients and particular concentration on smaller loan sizes, particularly below 500,000, more so than in prior years. Overall, though, the share of coffee lending has ebbed and flowed in the CSAF portfolio, as you see across the years on the screen. Declining through 2016 as CSAF members grappled with the coffee leaf rust I just mentioned a second ago, but also pushed out as the portfolio moved into new geographies and new value chains. CSAF lending in coffee has now stabilized at around 45% over the last 2 years, and that's an increased focus on existing clients, in particular in 2017 and 2018. Similar to coffee, disbursements in cocoa and cashew nuts, the next two most financed value chains, declined in 2018, where the share of disbursements did not change compared to overall 2017. So the overall decline in lending in 2018 is also reflected, as we saw on the next slide, in a consolidation in clients. CSAF members reached 711 clients in 2018, which is down from 794 in 2017, a decline for the second year in a row. At a global level, CSAF members focused their lending on existing clients, which represented in 2018 93% of businesses financed that year. This figure contrasts with existing client representing 57% of clients in 2013 portfolio, when the member portfolios were in really rapid growth, or even as recently as 2016, where existing clients represented 82% of portfolio. At a regional level, we see two different profiles emerging. In Latin America, Central and South America, CSAF lending in 2018 focused primarily on existing clients. In fact, approximately 75% of clients in that region have been financed continually by CSAF members since 2014. So we could say that the member portfolio in Latin America appears more mature. On the other hand, in Africa, we can see that there's been a substantial churn in the client portfolio, and this is in a portfolio where there's a rapid growth over the recent years as well. In fact, Africa alone in 2018 accounted for 50% of all new clients that year. So a lot of new clients coming to that portfolio. Even as CSAF members doubled down on their existing client base, we can see that due to decreased commodity prices, particularly in coffee and cocoa, and what I mentioned earlier about conservatism in lending, that this has brought about a smaller average loan size or smaller average lending to clients. In 2018, 48% of all loans were less than 500,000 US dollars. And for new borrowers, the median loan size was just 250,000 US dollars. In fact, 2018 marks a shift in loan sizes from the prior periods of rapid portfolio expansion. Loans below $500,000 had been slowly decreasing the portfolio share, down from 49% in 2015 and from 44% in 2017. Where clients are now receiving loans over $1 million US dollars, they're primarily receiving loans, in fact, from multiple CSAF members. So I'd wrap up by saying that we cannot really conclude the snapshot with, of course, talking about risk. In fact, the overall level of portfolio at risk at 30 days declined in the CSAF member portfolio from 8.5% in 2017 to just over 7% in 2018, reflecting the overall trend in portfolio consolidation and focus on proven clients that we saw last year in 2018. Here again, the experience differs importantly between regions and loan sizes. In fact, after several years of higher portfolio at risk, South America portfolio quality actually improved in 2018 as portfolio at risk dropped from 11% the prior year to 6% in 2018, particularly due to recovery in portfolio quality on the coffee lending, as I mentioned before. In regions of more rapid expansion, including Africa and Southeast Asia, portfolio at risk remained high, and in the case of Africa, actually increased from 5% to 9% from last year to 2018. On the loan size basis, we can see that smaller loans, the bars on the left-hand side of the screen here, continue to present a much greater repayment risk than the larger ones. Portfolio at risk over 30 days for loans less than $250,000 doubled in 2018 to almost 23%. Loans under $250,000 are in fact 5 times more likely to face issues or go into arrears than loans over $2 million US. So we can see the risk associated with these particularly small loans for agri-SME lending. Lending to agricultural SMEs in low and middle income countries we know is risky. CSAF members report delinquency challenges due primarily to internal factors such as management capacity and misuse of funds. In addition to these types of challenges, they're also operating in countries that face climate, market, or political challenges. In 2018, political risk flared up in 2 countries that were in the top 5 in terms of CSAF disbursements in 2017, Nicaragua and Tanzania, both of which experienced increased risk in portfolio risk in 2018. In addition, coffee prices, as I mentioned earlier, declined to levels widely considered to be below the cost of production, let alone living wage. And portfolio risk had also declined in part because CSAF members have pulled back from less formal value chains where cash flow-based lending approaches may not be as viable. As we wrap up this short snapshot, I'm going to ask Brian to pass the ball back to me for a second. I just want to call out that everything that we shared today and much more is actually available through the CSAF Open Data Portal that I mentioned in the opening to this screen. So you can hopefully see this now as I'm mousing over it. Of course, I've left it there for too long. There it goes, coming back. I think what's really exciting about the portal is that it's allowing each of you, anybody, all users, to explore the same topics that we just covered in greater detail, and more importantly, to start to actually interact with the data as well, so that you can drill down into the same data set that we just talked about at a high level from CSAF members, to look at analysis by region, by value chain, and much more. I'm just going to flag that this is version 1 of the data portal, and we very much welcome your feedback as we continue to improve this tool over the coming year. So that's a quick snapshot of trends and also a quick glimpse into the data portal. With that, Brian, I will hand this back over to you.
Thank you, Blaine. Let's see, let me get my slides back. So Blaine, thank you to you and your team at Mix for building out this portal, for your longstanding partnership. As you said, we are really enthusiastic about making this data more publicly available, and we welcome feedback at any time about how to build upon it. And we'd also like to thank Omidyar Network, which funded this work to make it possible. So there's of course much more detail in the CSAF report. We've decided to do a deep dive in East Africa and focus on ASELI Africa, but we really encourage everyone to go online, download the report. It has features discussion around trends in the coffee market, prices, changes in buying practices that are affecting producer organizations, affecting farmers, discussion around climate, and any number of other issues. So please check out the report. The headline, though, is what Blaine alluded to, the decrease in top-line lending for the first year since we've been gathering data in 2013, and the related portfolio consolidation with existing clients and in more established value chains. And that headline provides a good segue from discussing CSAF's global lending to a regional deep dive in East Africa and the ASELI Africa initiative. So a bit of context on ASELI Africa. In late 2017, CSAF members convened a stakeholder meeting to discuss the challenges of financing agricultural SMEs in our target markets. And in particular, lenders identified a mismatch between the risk-return expectations of capital providers, even impact investors and development finance institutions, and the addressable demand in the market. And out of that discussion, CSAF joined forces with the Global Development Incubator to begin designing an initiative that we called Prosper Africa. Over the course of last year, 2018, we partnered with Dahlberg Advisors to gather loan level data on the actual provisioning costs, operating costs, and costs of funds for about 4,000 transactions totaling just under $3 billion of agricultural SME loans from 20 different institutions, including both CSAF members and local lenders in East Africa. Another round of data collection is currently underway with an additional 10 commercial banks in Kenya, Rwanda, and Uganda, and we'll be releasing a report later this year to share those findings. So while CSAF has initiated this financial benchmarking, the data collection is now reaching well beyond our members to the full range of commercial lenders and even some government development banks in the market. As we're compiling this data and designing targeted solutions in response to the findings, in December 2018, the US government announced its new policy for Africa, and they adopted what we thought was a really great name, Prosper Africa. And in order to avoid confusion between that policy and our initiative, we decided to rename. So in March, we became Stawi Africa. Stawi means prosper in Swahili. And then in May, a new and unrelated initiative was launched by the Central Bank of Kenya and 5 Kenyan commercial banks called Stawi. And so if the initiative I'm about to describe sounds familiar from last year's call, it's because the substance is the same and we've simply changed the name one final time to Aseli Africa. Okay, so now for what Aseli Africa actually aims to do. We know that inclusive agricultural transformation is critical to achieving the Sustainable Development Goals, particularly related to poverty, hunger, gender equality, employment, climate, and biodiversity. We also know that SMEs are disproportionately inclusive in both their sourcing from smallholder farmers and employment creation for low-skilled workers. And on the other hand, Blaine spoke earlier about how CSAF lending to agricultural SMEs in Africa has declined in 2018 as lenders are tightening their risk criteria after a period of growth. And we also know that bank lending to the agricultural sector accounts for less than 5% of their total lending, and that national governments still lag in their funding for the sector. So the result is an agricultural finance gap of an estimated $180 billion a year across Africa, of which roughly 65 is for small and medium enterprises. The Kenyan Bankers Association released a report last year which drew very similar conclusions to the financial benchmarking analysis conducted by Dahlberg, namely that the risk-adjusted returns are too low to justify commercial lending to agriculture. So the goal of Aseli Africa is to raise the risk-adjusted returns of lending to agricultural SMEs enough to attract competition into the market and to work with existing actors in the marketplace, leveraging their balance sheets, capital base, operating footprints, and expertise. And our vision is a future where thousands of SMEs form the backbone of a thriving and inclusive agricultural sector that creates economic opportunities and drives food security and nutrition across sub-Saharan Africa. So what is Aseli Africa? First, it is a market-based facility providing financial incentives to increase lending to agricultural SMEs in East Africa. And we plan to start in Kenya, Rwanda, Uganda, and Tanzania. It draws upon the data on lender economics collected by Dahlberg to optimize the impact and leverage of financial incentives or smart subsidy. And we plan to offer 40 million in financial incentives for lenders and 10 million in technical assistance for agricultural SMEs over the next 5 years, beginning in 2020. And we believe that those incentives in TA will unlock 700 million in lending to agricultural SMEs that in turn generate 200 million in incremental income for over 1 million farmers and enterprise employees. Bigger picture, we aim to strengthen local financial markets and food markets as well. So CSAF members will be eligible to participate, and we expect that many will in Aseli Africa, but we also expect that at least half of the lenders will be non-CSAF members, and also that at least half of the loans will go to staple food crops for domestic consumption. Our goal is for Aceli Africa to be a demonstration model that builds the evidence base so that African governments invest their own resources in promoting access to finance for agricultural SMEs within the next decade. And we'll continue to partner with Dahlberg on the financial benchmarking and with Mix to distill lending trends and share them publicly through the online portal. And we'll also be partnering on evaluation with the International Growth Center housed at London School of Economics. In addition to its strengths in research, IGC has offices in each of the 4 focus countries and established relationships with ministries of finance, agriculture, central banks, and other policies at the local level. So it's well positioned to bring the research findings into the national policy dialogue. And just zooming out for a moment, our aim is for Aceli Africa to demonstrate and be an example for the type of blended finance solution that's needed to go from billions to trillions to achieve the Sustainable Development Goals. So now for a bit more detail on Aceli Africa's product offering, and I'm going to go through this fairly quickly, but then Liz will speak to it in more detail on the panel. First, we aim to increase lender risk appetite by providing a first loss coverage at a portfolio level. And Liz will explain how this approach differs from a traditional loan guarantee mechanism. The second approach is recognizes that risk exposure is a significant barrier to lenders serving agricultural SMEs, but it's not the only one. We want to incentivize smaller loans and particularly loans to first-time borrowers by increasing revenue for lenders where loan underwriting and management costs are otherwise higher than borrowers can afford to pay. Third, we recognize that capital supply is only part of the equation, and there's at least as much need to increase addressable demand among SMEs. We plan to contribute to that by facilitating technical assistance to high potential SMEs using a cost sharing mechanism with pre-vetted TA providers. In the medium to long term, we see that market growth will depend in large part on identifying technologies and other business model innovations to drive operating efficiency and financial sustainability for lending in high impact but otherwise difficult to serve market segments, particularly smaller loans and less formal value chains. And we're in the process of developing an innovation window that would target these disruptive business models alongside the 3 offerings described above. And then lastly, we aim to use data to optimize the targeted financial incentives and make the case for policy and budget reform to support agricultural SME finance at the country level. Just in terms of where we are and the partners who have supported us in getting this far, we've raised funds from the 12 institutions listed to conduct the data analysis over the past year plus, and also to design the initiative. And we expect anchor funding commitments for the implementation of Aceli Africa later this year, and to launch the initiative in early 2020. So with that, we're going to turn to our panelists. I just want to pause to encourage people to be submitting your questions in the chat function, since we have left some time at the end. But I'm going to start now with you, Michael. Michael Musau, currently investment manager for CSAF member Alterfine, and previously investment officer with another CSAF member, Shared Interest. But long before that, I understand, Michael, that you grew up on a farm in Kenya and that you're also now a coffee farmer in your spare time. So if you could please share a bit of your background and why you chose to work in agricultural finance.
Thanks, Brian. Hello, everyone. And really what I will just start by saying is that my entry into agriculture wasn't quite accidental. Obviously, like many other Kenyans, my father has been a farmer, and typically this happens because the majority of Kenyans are farmers by default. So I grew up mostly in the farm, and I will not say that I had an excellent opportunity to see. I had an excellent opportunity to see firsthand the challenges that smallholder farmers face generally. And this is typically from, armyworm for staple food, the wrath of climate change, to lack of markets, to nearly everything they grow that's affected by the vagaries of weather. And even when I majored in corporate finance in school, my work mostly revolved around social aspects of finance. I will typically write a lot of articles on the subject for local and international media. And after school, I had the opportunity to interview for 2 jobs. Luckily, I got to both. That was one at an investment bank and another one at a microfinance bank. I opted for the investment bank, which I did for about 2 months. And although I loved the job, I'd say that my passion, I think, was leaning more towards the development aspects of finance. So I quit and joined the bank, luckily. And for me, it was the introduction to smallholder agriculture finance, as the bank's portfolio was primarily micro enterprises and agriculture. A couple of exciting years, of course, at the bank got me eager for bigger challenges. And I ventured, of course, out setting up a consultancy company in Nairobi, then working at the IFC World Bank. Both of these opportunities deepened my understanding of the SME and the East Africa regional dynamics, especially when it comes to agriculture finance and SMEs. But then, for me, the real awakening was to the good and the sometimes difficult side of commodity trade was actually a shared interest, because this is where I started seeing the farmers' challenges firsthand at the larger scale. In some countries like Rwanda, for example, farmers relatively survive from their coffee operations. And this is not the case typically in Kenya, partly so in Tanzania and Uganda, where the challenges are more. The gain to the farmer is probably much lower and the regulatory environment is not as favorable. But why is Kenya so special to me? Because I have a few coffee trees, of course, in an area where farmers continue to approach their coffee in their farms. And this happens because they want to grow maize and beans just to survive. And why is farming suddenly becoming important to me? Is because of the new awakening that farmers can actually learn by example, not just approach their coffee trees, but actually even grow more coffee trees because they see some value in future. A lot of times what I do is encourage them, of course, why their cooperatives are very important, why they need to stay together, look for a market, because by consolidating their harvest, then they are able to negotiate for better prices. And in doing so, they are able to actually improve their livelihoods. So I would say that for me, agriculture finance has been more or less a passion for the past 15 years in my career. And it started way back before I graduated from school.
Michael, thank you for that. It's your personal and professional background give you a strong grounding to be commenting on agricultural SME finance. And maybe you could speak a little bit to the challenges that you've seen as a loan officer, shared interest now with Ultrafine. What are the biggest challenges, particularly to identifying and bringing new SMEs into the portfolio?
Okay, let me just start by saying that working with SMEs is possibly the most challenging of the segments. And it's even more complex in the ag SME space. And this is not just for the social lenders, but commercial banks. Because as Blaine explained earlier, the banking levels to SMEs and ag finance is actually less than 5%. And for most countries in East Africa, it's the least regulated, and perhaps explains why the tax collection system spend millions of dollars just trying to get them under the regulatory framework. But that too has not been as easy. For example, in Kenya, the Kenya Revenue Authority, I think, has been struggling to get as many of the SMEs into the framework. And I'd say that one of the key challenges in the ag lending sector is the corporate governance structure of these SMEs. But the challenge obviously goes beyond that, because efforts to help them improve corporate governance are mostly seen as takeover bids. And this is even worse when investors are coming in form of equity. Typically, a lot of them will be repulsive purely because they do not understand the financing dynamics when it comes to equity. Second one, obviously, is a lack of systems and in other cases, weak systems. And this is to the extent that when one wants real-time data, it becomes very difficult. And it's even more difficult to retrieve it, as this is actually adversely affecting the ag lenders. The other challenge, obviously, is the poor records. You'll agree with me that audited accounts don't come easily, especially in East Africa. And even when you get the audited accounts, sometimes they cannot be relied upon. And it's easy to actually make poor judgments when making an investment decision, especially relating to ag SMEs. I'd say the situation is even more difficult in East Africa because the way audit procedures are set and the cost of audit is generally very high for some of the SMEs to actually afford. The other one is access to markets. Typically, a lot of the commodities produced require a ready market before the harvest. A lot of them have very small farms, and it becomes very difficult to aggregate their produce because they are not in formalized establishments. So trying to get to understand the operations and the aggregation point becomes very difficult for the lenders. The other one, obviously, is a cultural issue, and it's the opportunistic mindset. And this happens a lot in Kenya, especially fresh produce, typically, then grain, which is a diversification option for ag lenders. There's the fresh produce and the recent wave, of course, of fruits and vegetables. And most of these businesses typically will run for about 3 years. And suddenly some of the lenders are actually investing in them in the second to the third year. And typically by the fourth year, they sort of go bust, and it's typically too late to actually recover. The final one I would say are the systemic issues, and these relate to the government policy, the politics of integration. And I mean, we know where things haven't worked too well. We've had the challenges in Tanzania in relation to coffee exports. And typically in some areas where it's just not working at all, especially the fresh produce sector in Kenya, that's also affected by a lot of regulatory changes.
Yeah, thanks for that, Michael. And maybe you alluded to some of the challenges in fresh produce, and maybe you could go dig a little deeper around that, because Blaine spoke about the consolidation in coffee and some of the top value chains. Of course, we know that there are many other value chains, fresh produce, staple grains, dairy and livestock, oil seeds, etc. Could you talk about some of the learning that you've had in trying to underwrite and manage loans in some of those value chains outside of coffee?
Great. So I think the idea of diversifying to non-coffee ag lending, of course, is an excellent one. I think it very much aligns with the CSAF Africa model. And for me at Shared Interest, I think it was a good learning. And one underlying reality is that there is a huge opportunity, of course, out there to lend into this non-coffee value chains. And there is, of course, a real need to support the producers. And just to put it vaguely, the world needs more than just coffee. We need staple grains, we need fresh produce, we need nuts, and we also need flowers. So it was easy, I think, for Shared Interest to sort of ignore these sectors purely because of the risk of default, which is extremely high. But then they did not do that. However, I think the challenges for smallholder farmers in agriculture applies across the board, whether it's in coffee, cocoa, tea, flour production, and the fresh produce, and even nuts and grain. And we all know, of course, the underlying factors in coffee and tea and cocoa and nuts. But then what about the rest? I'd say for flowers, majority typically will depend on direct sales. That's through Flora Holland. But this is a primary market for flowers that is highly volatile. and typically worse than the NYSE and the London LIFE. But for the case of grains, it's mostly domestic markets that are heavily regulated, obviously, and affected by seasonalities. The typical farmer will grow, say, maize and beans when it's rain season, sell immediately after the rains when prices are at their bottom lows. But then, when they choose to store this for a longer period of time, there are the challenges of logistics, storage, and the government policy changes, especially in Kenya, where grain is typically heavily regulated, and the incentives typically are available that do not reach the bottom of the pyramid. But then generally for SMEs, the challenges are just what I explained. It's difficult to understand the corporate governance structures for a lot of them, the challenges of finding a market, and the challenges of information to actually make a good judgment before investing in them. But for lenders, obviously, within the CSAF network, who've embraced these sectors, I think there has to be some real incentives, as the risks are just too high for lenders to actually go out there and diversify their portfolios out of, core segments like commodities, coffee, where, you'll typically be assured of a contract at a fixed price, and therefore repayment comes to at a fixed date. So thinking about it, of course, a lot of these things don't come easy. And I would say that's why banks will not lend to these sectors without a collateral.
Thanks, Michael. And last question before turning to Liz, how do you see Aceli Africa affecting Ultrafine's risk appetite and lending strategy?
Thanks. So for Ultrafine, the strategy has all along been committed, of course, to supporting a huge amount of its portfolio to the less formal value chains, the ones that I just explained before. And obviously, we see a huge challenge as these value chains are less and mostly unregulated. Ultrafine understands and is constantly, of course, assessing the mitigation strategies that can work to minimize the risk in lending to these value chains. An example, of course, is lending in local currency, which we are researching as much as we can. But the challenge with that is that there are no tools in the market to allow us to sort of hedge against forex risks. Another option typically that has worked before, even in my previous job, has been identifying a cluster of smaller borrowers to minimize the costs. So you typically sort of conduct due diligence on 3 or up to 5 of the smallholder cooperatives or SMEs at the same time. But this has also not always worked. So the reality is that there is a huge amount of resources that have to be put on a daily basis. And this is not just by Ultrafine, but other social lenders towards conducting due diligence, especially. I have, for example, once taken a drive for 5 hours, then I bought for another 2 hours across Lake Kivu to a cooperative that just needed about $100,000 just to finance their 2 containers during the season. Think about the costs versus return, and your bet is as good as mine. Nearly no returns to the lender, but lenders experience this all the time. And this is why I think Ultrafine is keen to work with Aceli Africa, because introducing such tools and the incentives will benefit us and enable us to manage the costs associated with these sectors. And in doing so, I believe we'll be able to lend to a lot more other value chains and really make a bigger impact.
Thank you, Michael. I'm going to turn over to Liz now and go a little bit deeper around Aceli Africa. So Liz joined as program manager earlier this year after working for several years as an investment advisor with the USAID-funded East Africa Trade Hub, and prior to that in financial advisory. And Liz, you've been meeting with local lenders in East Africa to discuss Aceli over the past several months. What are you seeing across the different countries in terms of lender interest in serving agricultural SMEs?
Thank you, Brian. Based on my previous experience at the East Africa Trade and Investment Hub, where I was supporting SMEs in accessing finance, one of the key observations that I've made is that there's a very growing interest among the commercial banks in the region to lend to the agricultural sector. This is certainly more than 5 years ago when I started working at the hub. But there's also been significant differences between the countries, and this is linked to dynamics in terms of the financial markets, as well as the government policies. And Michael spoke about some of these dynamics. Here in Kenya, the government has included food and agriculture among its big 4 policy priority. And just recently, it's launched the Agriculture Sector Transformation and Growth Strategy, which is aimed at modernizing agriculture in Kenya. And the aim is to boost agriculture contribution to the GDP. And as much as this is a good step, we know that in the country, bank lending to the sector is still very low, about 5%. And as much as the government wants to achieve this strategy, SMEs will really struggle to access credit. And the access to finance challenge was made a bit worse with the capping of the interest rates, where the aim was intended to make lending more affordable, but this resulted into a strict lending criteria, as most banks are not able to compensate for taking high-risk clients. So the banks are lending mainly to secured clients and are servicing larger loans. And what happens is that smaller loans are not getting serviced as much because they're less profitable. So I will say that even within the interest cap rate, I'm surprised to see that there's a lot of uptake in terms of banks wanting to increase their lending to agriculture. And this then creates an opportunity for what ASELI plans to offer. And that has been the consistent feedback we've gotten for a majority of the banks that we've spoken to so far. And yes, Brian?
No, go ahead, Liz. I was going to ask you to comment on some of the observations in other countries.
Yeah. One interesting difference between the agricultural markets in the region is that in Kenya, there's need to develop primary production more because our processors are looking for more reliable supply. Whereas in Uganda and Tanzania, the challenge is the opposite. There's surplus production and more is needed in terms of processing and value addition in the country. In terms of bank lending, if we look across the different countries, in Rwanda, the ratio of lending is even smaller than in Kenya, where it's 5%. And some of the leading players in terms of the banks, they are making a strategic push around, moving to digital wallets and having financial products. But this is really targeted for the smallholder lending. So we're waiting to see how this will develop to having a more vibrant agriculture SME sector, which will interest lenders more to serve it. We've recently been meeting with banks in Uganda, and I was struck by how much further along they seem to be in terms of their agricultural lending. Many are already allocating about 15% of their portfolios to agriculture. And even for some that are microfinance institutions are also doing quite a lot in terms of SME lending in ag, with an aim to reach about 25% of their portfolio in the sector, which is something good because they want to have the same proportion of agriculture as it comprises in terms of contribution to the GDP of the economy.
Yeah, that's very interesting about the differences in Uganda, and maybe you could say a little bit more in terms of how lenders are approaching the market there.
Yeah. First of all, I think that Uganda has been, the institutions there have had dedicated agricultural lending teams for many years. So agriculture lending is already a part of the bank's culture and policies. And some of the institutions that we've spoken to already have specific agriculture lending products, which they say is a key thing for them to understand really how to serve agribusinesses. And you may ask, why is this important? Other key departments such as credit risk and treasury then are more aware about the risks and in the sector and are more tolerable to lending to the sector. And this gives an easier time for the agriculture team when they're negotiating for lending. So within the organization, there's already sort of like a coherent way of achieving the strategy of increasing lending. In Uganda, we've also seen that some of the collateral policies tend to be a little bit less onerous, and some of the banks are offering unsecured loans. Even if it's within smaller amounts and only for businesses that are close to the bank branches, because this makes it possible to do more intense monitoring. But this is definitely much, much better than what we've heard from the banks in Kenya and Rwanda, where collateral requirements are about 150% and sometimes 200% the value of the loan. And this is also not on actual value, but the first sale value. And even when assets are much, much further in the rural areas, there's a further discount to it. So making, the access to finance challenge even worse, especially where the value is highly discounted. Another good thing that the agriculture sector has benefited from is government support. So the government of Uganda has provided, the agriculture credit facility for the last 10 years. And we've seen that this has led to the financing of about 450 agricultural projects. So government support has been also a major driver within the country.
Yeah, and the agricultural credit facility you mentioned is a 0% line of credit from the government that blends down the cost of funds so that the lenders can offer a cheaper interest rate to the borrower. Liz, could you also talk a little bit about how Aseli Africa is different from other risk-sharing mechanisms that are available in East Africa?
Yes, Aseli Africa aims to take a new approach that is complementary to existing facilities in the market. And I can speak to some of the defining characteristics that Aseli Africa has. First, the financial incentives we offer will be data-driven because we're actually collecting data, which Brian talked about, that is looking at the actual lending economics and the risk data. And we're gathering this data from about 30 market actors. And this includes the CSAF members as well as the local banks and the non-bank financial institutions. And this data-driven approach is, first of all, something that we've not seen anywhere in the African agricultural finance sector. Second of all, most efforts to date have taken a push strategy, where capacity building and loan guarantees are offered to individual institutions to encourage them to increase lending to agriculture. By contrast, what we're working on is a market level solution where we want to offer a standard financial incentive for a given type of loan to each lender. And this will create a pull mechanism where lenders are best positioned to serve the given market segment, either based on their strategy or their cost structure, and can actually respond and apply for the incentives and compete on a level playing field. Then with the data we are collecting on an ongoing basis, we can reduce the incentives as the market becomes more efficient, and then less subsidy will be required to incentivize any given loan. The third difference is the financial incentives themselves. Speaking to banks, of course, a lot of them already have risk-sharing facilities, and the most common one is guarantees. And guarantees are usually structured as a 50% risk-sharing facility on a loan-by-loan basis. And when we talk to the lenders, they're either comfortable with the risk of a loan and they want to lend to the loan to their client anyway. And in this case, there's usually collateral, and they don't feel they want to pay a utilization fee or put the business under guarantee. And if they're not comfortable to take the risk, they might not take the loan even if a guarantee is available. And the reason is because they might still lose 50% of the principal. So based on this, we hear that the loan guarantee facilities often have low utilization rates. So our first approach is to offer the first loss cover. And we'll assign an expected level of default to each loan based on characteristics such as the loan size, the value chain, the borrowing history. And we aim to, and let's say, for example, the average non-performing loan ratio in agriculture in Kenya is 5%. So if a bank wants to make a 200,000 loan to let's say a sorghum aggregator in Kenya, the expected default will be 5%. We will reward the lender for making that loan by depositing 5% of the loan value, which is about $10,000, into that lender's reserve account. The more loans the lender issues that meets our impact criteria, the larger the reserve account grows. Then when there are any losses across the portfolio of loans, the lender can draw on the account. So that's the aim, is for them to build their reserve account such that it can cater for the losses within their loan book in terms of their ag portfolio. And we believe that this approach will allow lenders to increase their risk appetite and serve a larger share of the market demand. And lastly, I want to talk about our second incentive. We recognize that while risk is a significant barrier to lenders, another major challenge is the high cost of costs to underwrite and manage loans, as Michael shared about, the 100,000 loan that they had to make quite far. So this costs usually, basically the borrowers simply are not able to afford the interest rates, and that lenders would need to cover their costs on these loans. So the incentive payments that we will offer, which will be an upfront payment, is designed to increase the revenue on small loans while still aligning incentives for the lender to do rigorous due diligence, since they are on the hook if the loan goes bad.
Thank you, Liz. Maybe just, we have a couple of questions coming in, but maybe I'll just ask you a short question, which is, what has been the response from the lenders around Aseli Africa?
The response has been quite positive. I would say that it's taken some time to develop relationships, particularly with the commercial banks. And the reason is because they needed to really understand the financial incentives, what we were offering, and to also get them to be motivated to participate. But I think a good indicator of their level of interest is how many institutions have been willing to work with us, especially on the data side, in terms of signing NDAs and sharing, very sensitive financial information with what I would call a startup initiative that Aseli is. When I joined, I think that was one of my biggest concerns, like, are we really developing a product that they really want? And it's been gratifying to see the response from the banks and their own push to build strategies to increase lending to agriculture. So it's been very encouraging over the past couple of months.
Thank you, Liz. And the questions are coming in. We'll answer all of them offline, those that we don't get to, but a few of them have been related to impact. And we've designed the financial incentives at two levels. The baseline incentive that we offer will be informed by the risk and the operating costs, basically the financial benchmarking. But then we also plan to offer additional incentives for loans that meet certain criteria around gender inclusiveness, youth inclusion, food security and nutrition, and environmental sustainability. And so, for example, around gender inclusion, we plan to adopt the criteria used by the 2X Challenge, which is the G7 development finance institutions, where there are various criteria around a business being gender inclusive related to ownership, management, employment, and sourcing practices. Those criteria will be layered on to the baseline incentives, so that a lender that lends to a farmer enterprise that is gender inclusive will be rewarded above and beyond a business that is not. And likewise around food security and nutrition, as we said earlier, our goal is that at least 50% of the loans are in domestic value chains and staple crops. And so there's a real emphasis here on food security and nutrition. Many of the CSAF members have begun lending in staple crop value chains and want to do more, but the costs and the risks have been prohibitive. So we expect that Aseli Africa will help them to push farther. And we also know that the local lenders who have access to local currency will be able to do many of these loans as well. So we're coming at the top of the hour. We're going to end the call here, but we'll be releasing the full transcript of the webinar on the CSAF website. And we're also happy to take any of your questions and feedback offline. Again, communications@csaf.org. Thank you to our panelists, Blaine, Michael, Liz, and thank you to all of you for dialing in.